So as Chinese stocks rise up from the dead again over the past 1 month or so, you can actually observe investor sentiments shifting in real time. In fact, people are even discussing about the prospects of owning some of these Chinese names in their portfolio. On top of that, I've even came across this infographic pitching the US Magnificent Seven, which we've known are the largest, biggest, most productive, most innovative tech companies, against this group of China's Terrific 10. So don't ask me how they came up with these group names, but I do know that if you smash the like button right now, it will be a terrific day for me. In fact, if you were to take a look, they basically charted out the price action or the price performance of this two basket of equities from December of 2023 until today. The China's Terrific 10 has basically caught up with the Mag 7 performance. So a disclaimer before I proceed, I think this video will be quite macro related, unlike my usual bottom-up kind of approach when I look at equity investing. So do listen in with a huge bag of salt. But anyway, I think before this enthusiasm kick in over the past 1 month, I believe we've all seen our fair share of people being pessimistic about China's outlook. And some of these people are quite renowned in their field. You have Ray Dalio talking about the real issues in China now. And this was published on the 18th of September last year. In fact, Yardeni also did an interview at the start of 2025 saying that China is still uninvestable in 2025. On the other side of the camp, of course, we also have huge proponents of investing into the Chinese market. So you have this Singapore fund manager saying that China may be poised for a decade-long bull run. China Renaissance also said that investors should maintain their weighting in Chinese stocks. And I think as I covered quite extensively on this channel, we've also seen Howard Marks giving interviews after interviews saying that Chinese assets might offer a bargain. That said, I think when you compare in terms of viewership and the common consensus right now, if you see people talking bad or talking down on investing into China, they are probably guaranteed to kind of hit a certain amount of views. On the flip side, if you're trying to be optimistic in a pessimistic market, the views tend to also take a hit. Now, I even took the liberty to go into the comment section to look at what are the common consensus today, and you see things like anything that comes from China is likely to be BS. Don't trust. Chinese fault for not allowing an independent capital market. Lies, lies, and more lies. Avoid Chinese stocks. And here, ladies and gentlemen, I present to you investing into the Chinese market. Now, a few notes before we proceed. I think the noise to signal ratio when you talk about investing into China today is clearly out of whack. And you need to understand the underlying incentive structure. So they're not here to provide you with useful information from the goodness of their heart. So we all have our own biases and agenda, and I think myself included. So the same publication, organization, or even person can play both sides by saying that they're both optimistic and pessimistic about China on different occasions. Think about why they want to play both sides and who are the stakeholders that will ultimately benefit. There are also many mini echo chambers out here, so just beware of which chamber you're currently in. Now, data and statistics are also meant to tell a story. Hence, manipulated to support an argument. So taking the first chart, for example, that I showed you previously, I can tell whatever story I want to just by playing with the time frame when I was comparing the Mag 7 with the Terrific 10. So take the facts for whatever that's worth and also formulate your own understanding and judgment. Try to differentiate between facts and opinions. Yes, you can consider the opinions being put forth, and I will be offering you my opinion in this video, but just take it, like I said, with a huge bag of salt. Lastly, I hope that you will take away the thinking process and the logic and not just take the conclusion at wholesale without your own input and judgment. But I think you guys are all smart folks here, so I won't belabor the point. So I think let's be clear, our primary objective, at least on this channel, is to pump the Chinese market. Of course, I'm just joking. Maybe for first-time viewers, you're unaware, but I do put my money where my mouth is at, and that's why I have a huge bias to the Chinese market because I have a more than 60% exposure on a portfolio level in some of these Chinese tech and non-tech names. So just keep that in mind. In fact, this video is kind of inspired by a recent blog by Investment Modes run by Keith, and he tagged the article with a very intriguing title. Perhaps China is not so uninvestable. Don't read this if you are very concentrated in the US. The blog post was summarizing this video that dropped on Valentine's Day by Louis Vincent Gave, where he was outlining his thoughts about the Chinese market today. So it's a 40-over-minute presentation. I highly encourage you to watch the video. But I think for this presentation specifically, I'm just going to extract a few slides that I think is relevant to this discussion and provide my opinion at the second half of this video. So Mr. Vincent actually outlined a few of his thoughts about the anomalies that are happening in the current global market environment. So the first anomaly that he painted was the impressive divergence between the Chinese and US 10-year government bond yield. In fact, pre-2021, if you do just take a very simple correlation between the red line and the blue line, they generally trended in the same direction. If one is trending downwards, the other one would also be downward sloping. In fact, if you look at the China and US yield difference, there is always some sort of a delta, or in this case a premium. Because if you pitch two countries' yield together, the one that is deemed more risk-free, in this case the US government bonds, would always have a lower yield. And the other countries, especially an emerging market or a developing country bond, would be so-called higher risk. Hence, they offer a higher yield. But I think after 2021, you can see that the relationship started to diverge. And as the US 10-year yield continued to trend upwards, the Chinese 10-year bond continued to climb downwards. And in fact, both are near their record. US being near their record high and China being at their record low. So the next biggest macro anomaly is that in 2024, China's trade surplus actually rose 50% and they're again at record high. So 6 to 7 years ago, I think the world has the idea that China wasn't that reliable as a trade partner. But since then, China runs a trade surplus of $1.1 trillion per year, and no country in history has ran a trade surplus of this size. Now, moving away from the macro talks, if we look specifically to stock market performance, I think the US exceptionalism story and narrative in the stock market has had many lives. And this is a simple chart that compares the US MSCI growth towards the world MSCI value. So in the past 20 years or so, you can see that there were three main narratives. Firstly, in the late 2000s, they were talking about the launch of the smartphone and in the midst of the internet revolution. Thereafter, after Donald Trump was elected, in the first time round, they had tax cuts, deregulation, and making America great again. After 2020, there were the stimulus checks and the tech boom. And right after the bear market of 2022, we have this AI excitement that we are experiencing in real time today. So the reason that is commonly cited is that US is doing so great because they have the best companies, best productivity, and you'd be a fool to be investing anywhere else, especially when greeted with charts like these that pull out the last 20-30 years of track record, and the US S&P 500 or even the Nasdaq just goes up 45 degrees to the right. And to couple that, Western media narrative on China has been relentlessly negative. I'm talking about it's over for Hong Kong, the China's model is dead, Chairman Xi has lost its way, etc, etc. With the recent collapse in yields, I think the China's doom story has gone into hyperdrive. But the funny thing is, Mr. Vincent actually outlined something to the contrary of this belief. In fact, when an emerging market is imploding, their yields tend to shoot up rather than fall because investors demand a higher premium for the risk associated when buying into their so-called government bonds. If you're to think about it, bond prices and yields actually have an inverse relationship. Meaning to say, if government bond yields are decreasing, means that bond prices are increasing. And for bond prices to increase means that demand for the government bond should be increasing. Therefore, when we think about the idea that investors might be losing confidence in the Chinese government or the Chinese economy, people might no longer be interested in holding the Chinese government bonds. That's why they will sell, and hence the yield should go up. And the reverse is happening, and it seems like investors are demanding a lower premium. On a third note, when we talk about China's collapsing economy, and we look at some of these news headlines coming out from Wall Street Journal or New York Times, they talk about China unveiling a new futuristic fighter jet. China's AI is catching up fast. They unveiled the prototype for the fastest high-speed train, and they propose further export curbs on battery and critical mineral tech. So does these headlines actually direct towards a country that is collapsing? And here's the thing, for those of you who are listening in, if we are able to turn back time to start of 2024, now touch your heart and ask yourself, which global equity market did you thought would outperform or would deliver the best return? No one would expect a collapsing economy to deliver one of the best, if not the best, 2024 equity return in US dollar terms. In fact, if you take a look at capital allocators in China over the past 3 to 5 years, comparing a portfolio of 50% equity and 50% bond, in the past 3 years, China, when compared to US, Japan and Europe, actually delivered a positive returns. So the question is, why bother? If you're fully invested in equities, the US market is the clear way to go because we have seen over the last 10, 15, 20 years, they've delivered spectacular returns. But at least from China's stance now, looking at the 50-50 balance portfolio, they're still trying their very best to kind of sustain the bond market, not sacrificing them for the equities market. And the relative comparison, when you look at China today, is that they have record low interest rates, they have record real low rates, they have government stimulus, their economy is trying to re-accelerate from a relatively low base, and their equity valuations are at the bottom quartile. And that's a very stark contrast to where both the US economy and the US stock market is at today. But just so you thought, with the extensive coverage about how China's economy is collapsing and the Chinese consumer is done for, maybe you can explain why, in terms of the domestic consumption, on both domestic trade, vehicle sales and registration, sales and passenger vehicles, they are going at all-time high. If consumers are extremely pessimistic about the future, with their lives being threatened, why do you think people are still interested in buying a new car? And here's the most important chart that you have to take away while looking at China's economy that is undergoing transition today. And here's what Mr. Lewis have to say.
In 2018, this is when the US government says nobody is allowed to sell semiconductors to China anymore. And this was a cold shower for the Chinese leadership. This is when they thought, okay, it's not a trade war, it's a tech war. The US is out to curtail our growth. It's semiconductors today. Tomorrow it could be car parts, it could be chemicals, it could be any number of things. We have no choice but to become self-sufficient in every single industrial vertical. Therefore, we tell our banks normal loans to real estate. What you're looking at, the red line, is loans to real estate. Instead, put all your money in industry. The banks were told this, and when the banks are told something, they typically do it. And so you see this massive shift in the Chinese economy. Now, what the entire Western world focuses on is this red line right here, that shows a massive real estate bust. And I think there's many reasons we focus on this, not least of which that we, the Western world, went through a real estate bust in 2008. And now we wake up 5 years later, 6 years later, 7 years later, and we wake up to all of a sudden a new reality where China is the biggest car exporter in the world, the biggest industrial robot exporter. China's producing better trains. China can produce nuclear power plants at half the cost that we can in the Western world. Pick any industry that you care to think of, and the West has been leapfrogged. Even fighter planes now. Fighter planes is one of the hardest thing to produce. While we're all focusing on the red line and talking all day about whether Shanghai real estate prices were going to go down another 10% or not, something that impacts absolutely nobody's life in here. This was happening. Now this impacts everybody's life and everybody's portfolio. Because if China is about to take over the global car market, this is very problematic for Germany, much more so than the Shanghai real estate price.
And there's a great anomaly of the massive Chinese trade surplus today. And how things usually work is that when a country runs a large trade surplus, there will be huge amount of capital inflow, and that will result in a strong foreign exchange and or higher asset prices, which would then lead to strong domestic consumption, and the trade surplus will be negated as they import more. But what seems to be happening in China today is that they're running massive surpluses. China's businessmen earn US dollars, but the entrepreneurs are actually lacking confidence to reinvest in either domestic stocks or property, or even just reinvesting back into the business to expand their empire. So money actually stays at the bank, and the yields fall to new lows as people continue to gobble up many of these bond instruments. In fact, they might even try to hedge their risk by buying gold or even keep their cash in US dollars offshore and use this cash to buy into foreign assets, thereby not completing the loop. So a very clear look is just looking at how much Chinese cash is sitting on the sidelines. And as I said, a lot of times, many of this discussion around the Chinese economy today is either that they are at record high storage or slippage, or at record low yields and prices. So that's where we are sitting at today. So starting from here on, these are just my own personal opinions. So let's first talk about macro. I think I don't wish to smoke you, and like all of you, we are all trying to do our best guesstimates. I don't have insights better than God. But here are my own observations and how I think through things. So investors' confidence are hit severely due to a myriad of different factors, such as the regulation, the continuous underperformance, a clear disregard for entrepreneurship and animal spirits. So there's a clear hit in terms of the wealth effect, and consumer confidence are at all-time low as well. Nobody's interested in putting their money into any sort of risk assets, and therefore you see the lackluster performance over the last 4 to 5 years after that crackdown in terms of the property sector. So hence, you can see that capital tend to congregate into all these risk-free assets, namely your government bonds. And there's quite a fair bit of coverage by analysts and economists alike with these two primary concepts of a liquidity trap and a balance sheet recession. For those of you who are interested, I'll probably leave the link in the description below on some of this coverage by analysts. And that would be a tricky situation because it's not as easy as just pumping stimulus in the economy to revive sentiments again. As I've said, the Chinese economy is humongous. There's too many moving parts. We can't be sure which specific policy actions or intervention that is going to help out the entire economy. But I think let's go back to the underlying core assumption. So in a strong and high functioning economy, which is a complete opposite of what China is today, what should we or what do we expect? I think you can think of a few core concepts, such as the confidence and the velocity of money, as consumers inspire confidence in terms of their demand, and therefore merchants or suppliers in this case can continue reinvesting back into the business to scale and grow, and thereby hiring even more workers to boost consumption again. So that's the first part, confidence and velocity of money. Credit expansion, people are willing to borrow money, whether is it to buy more assets or to expand productivity and business, which then lead to the productivity growth. And last but not least, investment and risk appetite. Clearly, when we look at the conditions of the Chinese economy today, they have none. In fact, some are working in the reverse. So with the current confidence collapsing, you think about investors, businesses, and even consumers hoarding cash, unwilling to deploy capital, moving into bonds, and even staying defensive. You have liquidity trap because you talk about cutting rates, and we have seen the PBOC of China constantly trying to reduce and cut rates, but it doesn't lead to more spending or investing because demand is weak and a lot of people are deleveraging their balance sheet. And you can even extend the discussion to a balance sheet recession where over-leveraged businesses, developers, and even consumers prioritizing their own debt repayments rather than expansion and essentially killing growth right at the butt. And last but not least, of course, you have talks about policy uncertainty. And there's a very quick shift in regulation spooking many of these investors' confidence. So moving on, what should be the next step? I think we have clearly seen signs or hints that the government is finally stepping in. They are trying to hold property prices, so to stop the bleeding, and they are also giving some sort of a capital allocation direction to insurance companies, to pension funds, trying to direct many of their capital to the equity market, and maybe even in the meantime trying to create a wealth effect to allow for normal laymen to also participate in this revival and to create the adjacent wealth effect. But this is only short-term and transitory. But in the longer term, we need to see real productivity, capital, and confidence growth back into the Chinese economy again. I think you can look at the stock market from two perspectives, one from the short term and one for the long term. So there's a lot of commotion around the Chinese equities market today because we've seen great short-term relative outperformance to many of their other counterparts. But I think I just like to focus on the idea that actually in the short term, anything can happen because it's mostly just narrative driven. All you need to care about is whether the story is sexy enough to sell to investors so that the multiples can expand, because it's purely demand and supply. So if there's more people trying to buy the stock than people that are willing to sell them, that's when the share price just go up in an exponential rate. And if I were to add an additional layer of observation here, if you take a closer look, I think comparing between the Hong Kong H shares market versus the Chinese mainland A shares market, although both of them have seen gains from their lows in 2024, the Hong Kong market is rallying much more aggressively over the past 2 to 3 weeks, which actually reflects the view of mostly international investors. But I think if you look at the mainland A shares market, I think growth in terms of share price and price multiple expansion, that is a lot more conservative. Also, in the really short term, in fact, in the next week, there are many discussions talking about some of these major headline earnings coming from both Alibaba and Baidu. Personally, I don't think the numbers will affect that much. Those earnings actually happened late of last year, Q4 of last year in fact. So it might actually give a litmus test as to the current state of their customers and the business health, but markets might be more focused in terms of the management's comments and guidance or even expectations to see whether there's still legs for the story to run, especially with Wall Street talking up many of this Chinese AI story. So in the longer term, however, I think the stock market is always driven by earnings because it's a weighing machine. And a small part would definitely be the investment multiple, especially premium multiples for high quality companies with still great growth trajectory ahead. So this earnings aspect actually requires a deeper look in terms of the individual business competitiveness, economic mood, consumer spending patterns and habits by a very large extent as well, reinvestment and growth, and of course, policy impacts, etc. So here's my final thoughts. Clearly, I cannot control macro, neither can I control micro. So what can I control? I can only personally control my own portfolio exposure, my buys and sells, and my patience. So all I know is this. As long as company earnings continue to hold steady, many of these Chinese names are still undervalued. They are currently unloved, so the multiples can only be on the low side. So if we don't get external interference that causes panic again, like regulators stepping in, positive activities tend to drive positive growth and momentum can start to build up pretty quickly. So on the point of international investors losing confidence and quitting the Chinese market for good, as we've seen in some of these comments from the videos above, maybe we want to revisit that assumption again. I'm not trying to say that all the investors will start to flock to the Chinese market, but you don't necessarily need the $93 trillion from the US market to all congregate back to the Chinese market. I think as long as when we talk about risk on assets, specifically talking about the realms of investing, actually, it takes very little for investors to get excited again, especially if they see 20-30% back-to-back returns after a few years. As long as they view some sort of a compensated risk and the risk-reward is in their favor. Now, markets are always forward-looking, and sometimes they can look a lot forward, especially when they're doing a catch-up from a low base. Plus, we are in an environment where it's hard to kind of find bargain deals. And don't forget, bull markets tend to be born in pessimism. And of course, the underlying assumption underneath is that economic fundamentals for both the economy and businesses have to turn for the better. Unless you believe that this time is different and there is no turning back or recovery for the Chinese market for good. So the conclusion from investment modes that initially introduced the video to me was that a 10-year underperformance in individual markets like Hong Kong, Singapore, is not uncommon. If you remember that even in markets like the US, there are long periods where the equity market did not do well. One of the reasons equities can have much higher returns is that there will always be these long periods of poor performance. Crap periods are a feature and not a bug in the system. If it just goes up steadily, consistently for 7% a year, then where are the risks? And he did conclude the article with a relatively safe statement. The more concentrated you are, be it in China or in the US, you live and die by that concentration. While you may celebrate their outperformance, it will eventually breed anxiety over the risks associated with that concentration. You think more about if the music will stop, what will cause the music to stop, and when will the music stop. And sure enough, coming from a financial planning perspective, all is good. And to basically round out this discussion, I have a few last thoughts here. I'm quoting an ex-post from Hao Hong, talking about the upcoming high-level conference with the private enterprises. So Huawei's founder, Xiaomi's Lei, and the new Hope's Liu will be speaking, but Jack Ma will attend, but not speaking, even though his attendance has significant signaling effect. ByteDance and Tencent will also attend. So this is a meeting to basically rebuild the confidence amongst the Chinese entrepreneur. And someone basically snapped a shot of Jack Ma leaving his jet today to be greeted by top-level officials in Beijing next week. And since the easing of the non-economic factor that has interfered in the Chinese economy in the past year, we are witnessing signs of confidence returning. And the Chinese government is showing a significant change of heart towards private enterprises. A move that costs no money but can have profound effects in jump-starting Chinese economic activity. So welcome back, Jack Ma and all the entrepreneurs in China. And feel free to leave in the comment section down below on whether you think this time is different. With that, I'll see you guys in the next video, but more importantly, I'll finally see you guys on the moon. Goodbye.
Today in China, again, economic data bottoming, fiscal stimulus, monetary policy stimulus, interest rates at record lows, record level of cash on the bank, China now outperforming every market, and nobody cares. Thank you very much.
Green Dragon, let's go.